Today, we had a huge miss on the ADP jobs number. You can see the actual number came in at 62,000 compared to a forecasted 114,000. This follows yesterday's JOLTS job openings, which were also weaker than expected. And perhaps most concerning of all, take a look at GDP growth. GDP growth came in negative for the first time in many reported figures, coming in at negative 0.3% compared to the forecasted 0.2%. And in response to this, the S&P 500 is taking a little bit of a break here, falling down from its recent push higher, and you can see trading around 5480. And you can see when we take a look at the S&P 500 on a daily chart, we are hitting that level of resistance that we keep talking about on the channel and tried to break through it yesterday, but didn't quite get enough of a strong breakout. If you've been watching the channel, you know we've been looking for this kind of move on the S&P 500 and the NASDAQ, looking for some sign of strength above this level of resistance, looking back at that 90-day pause level of resistance as well for some sort of key breakout. However, when we look at the NASDAQ, things look a little bit better. I actually think price action looks healthier on the NAS as that 90-day pause level of resistance actually is trying, at least at the time of recording, to hold as support. Dropping down to the 4-hour chart, I do like the idea of actually getting long the NASDAQ if we can get a bigger retracement to this 38.2% retracement level on the 4-hour chart. The NASDAQ is still a very bullish reading on the Edge Finder, despite losing a bit of score to our GDP numbers that came out this morning. And a key reason for this is because even though GDP may have come in weak, we still want to take a full conclusive look at the economic data, technical data, and sentiment data when trying to score an asset. Many traders make the mistake of only focusing on one thing at a time, but really, in my opinion, it's very important to look across the board, across many different key metrics that move price in order to get a better understanding of a market's particular bias. So I'm going to continue looking for a NASDAQ pullback because most of my indicators still point bullish. Another chart I'm watching pretty close is the dollar yen. I want to show you some cool stuff that I found, in particular with this -6 score. So first, when we look at the dollar yen in terms of a price action perspective, this is a very clear and clean downtrend on the daily chart. I'll be looking for retracements as an opportunity to potentially pick up a short position because I found something very interesting that I want to talk to you guys about. What you're looking at right now is the commitment of traders data history for the Japanese yen. This yellow line represents the long percentage over time, just kind of taking into consideration both long and short positions held by institutional traders. The commitment of traders data allows us to track what institutions, specifically hedge funds and banks, are doing with the Japanese yen futures contracts that they're trading. And over time, you can see something really interesting has been happening. We went from a very short bias Japanese yen, according to institutional traders, to now seeing massive buying accumulation of the Japanese yen. In fact, going back towards that kind of crash that we had in August of last year with the carry trade unwind, it seems like quietly institutional money has continued to accumulate long positions in the Japanese yen over time, pushing us to a multi-year high of 89% of positioning being on the long side. So what does that mean for this chart? Does it mean it should go up or does it mean it should go down? Think about that for a second. The answer is that it should go down. Because again, if we're talking about institutional money aggressively buying the Japanese yen and offloading the US dollar, that basically is the idea that we should see continued yen strength because institutions have been loading the boat on long yen trades. Now, does this guarantee that the Japanese yen is going to be strong going forward? No. But typically institutional money is on the right side of the move, and they've continued to accumulate long positions on the Japanese yen, so I do remain bearish on charts like dollar yen, euro yen, pound yen, and CAD yen. But the one that I like the most is still the dollar yen, simply because of its Edge Finder overall confirmation. So while it's not a trade setup at this time, this is one that I wanted to keep on the radar in case we do see a larger pullback up to a key level of resistance like 147 to 148 in price. And perhaps the Japanese yen is attractive to institutional money for the same reason that gold is attractive to pretty much everybody. Gold offers a little bit of a safe haven to all of the craziness that's happening in 2025, all of the trade negotiations, the uncertainty, what's happening in Ukraine and Russia. There's so many things, this China-US tension that's going on, China-Taiwan. Many investors are opting out of what has been a US-dominated kind of marketplace globally into something like gold, which is an alternative and a place people feel they can hide out. I do still have a long position on gold. I've actually seen multiple times on the daily chart, check this out, how prices come down and then found support. This is at least in the short run looking like a potential bottoming is starting to form on gold. But if it does not, I do have a stop loss in place and a small position on this one. So I'll take a small loss if needed. But gold continues to be probably the most powerful winner of 2025, at least for now. And with stocks really struggling in 2025 and the dollar also plummeting, things like gold and the Japanese yen, which we would consider risk off markets, still look very attractive. By the way, if you do not already have the Edge Finder, today is a last call for our 45% off discount that we are doing on the tool at this time. The Edge Finder allows you to track tons of market data, including institutional positioning, market sentiment like the crowd sentiment, economic heat maps, economic growth data, inflation data, and so much more. Labor data, all sorts of stuff. It also ties it all together with our top setups algorithm, which is what I use every day to find the trades that I take. So if you don't have a copy of the Edge Finder, don't miss the discount. All the information can be found in the description down below. So with all this weakness in US economic data that came out this morning, it's no surprise that we see things like the 2-year and the 10-year yield down pretty significantly on the day. And taking a look at probabilities for rate cuts this year, by 2025's end, the market now expects 1, 2, 3, 4 rate cuts by the end of the year. That's very different than the one rate cut that we thought we were going to get when the year turned. And this has people wondering, with rate cuts coming in quickly, is the Fed starting to panic? On Friday, May 2nd, we'll get April's numbers for the NFP report. And you can see we are forecasting 133,000 jobs to be added. That's much lower than the previous 228,000. This number holds the key in terms of what the Fed is likely to do this year for rate cuts. This is a really important report. In fact, I've done a full video on this topic of how to read NFP reports recently on my channel to help people prepare for this. Check it out in the top right of the screen right now. And today's video is sponsored by Maven. Maven is the quote-unquote easiest Forex prop firm to get funded with. And one of the biggest call to actions that I see on their page is basically they have some of the lowest cost ways to get funded with as low as $15. They provided $50 million in funding. You can get funded with as little as $15, and you can get funded up to $1 million on their virtual accounts. They have one of the highest Trustpilot scores I've seen in the industry, and I highly recommend that if you're looking to get funded this year, check out Maven down below in the description.
So I don't think we're going to see something next week from the Fed, but certainly things are fluid as far as what happens in the next few months.
Would you agree with that assessment from Kenny and Nick that there's absolutely no chance of a rate cut next week, whatever happens to non-farm payroll, and despite this GDP fall today?
So here is a personal opinion on the matter that I think it might, spice things up, make things interesting today. So when did Powell last make kind of a surprise cut? It was the 50 basis point cut before the election, right? Which got all sorts of up in arms about people saying, oh, that's, infringing upon the election, all this and that. I do think it is fair to say that Jerome Powell is especially staying focused on his dual mandate right now, rather than trying to lend a hand to the Trump administration. I think that's a fair way of putting it, but not necessarily saying he's totally, politically incentivized by any means, but there is this willingness to stay true to the mandate and not just to bend to the will of Donald Trump. So I think that he, in some ways, may actually, by Trump, aggressively taking a stance to try and get him to cut rates, I actually wonder if I was in that position, if I would be like, no, I really need to see the data to cut rates, right? So I actually think, to Kenny's point, the chances of a rate cut are very low, even if you get a soft NFP report for a cut on May 7th, because again, it would be, in some ways, it may signal that he's caving to the demands of Donald Trump and going back on what he just said about his dual mandate. So I think that's not a great look. And I also think that it would signal some worries in terms of, he's put the perspective of I'm not going to cut until we see this, and then he turns around and cuts, I think that would actually spook the market a little bit. And so that's my opinion on it. I think there is potential, some politics on this, but really I do think Jerome Powell, for the most part, is sticking to his goal, sticking to the Fed's goal. Fed inflation, or looking for inflation to continue to cool. You know, Johnny, in the UK where you're at, we saw inflation go down to 1.7 and then jump right back up. So we're at 2.4 in the United States with the CPI. There is worries and past examples of inflation, you know, reversing course and going back up. And I do understand from the Fed's point of view, cutting interest rates too soon, especially when we don't know the impacts of all this tariff stuff. I think it's fair to say, look, the labor market is not in critical condition. The U.S. economy is not in critical condition. We've had great couple of years of strong growth. It is okay as long as we don't see significant deterioration from here in the labor market and in the GDP growth and all that stuff. To maybe take it slow and to take their time. I actually think that would instill some confidence in the U.S. markets as opposed to, you know, bumping it up to 5 cuts this year.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.